Welcome to the Leaders Insights podcast. Today's episode, Investor Relations in 2026, Why CFOs Can No Longer Outsource the Narrative. CFOs have always had investor relations teams for a reason. So why is that model breaking down in 2026?
Because the market has gotten faster than the delegation model can handle. When a macro signal drops on a Tuesday morning and your stock moves 3% before lunch, the IR team fielding calls doesn't have the contextual depth to contain the narrative. That gap costs you. We've seen companies like Siemens Energy and Ørsted watch their cost of capital widen, not because their fundamentals changed, but because the story fragmented under pressure.
So is this fundamentally a speed problem or something deeper?
It's structural. Institutional investors in 2026 are running much more sophisticated pre-meeting analysis, AI-assisted earnings transcript modeling, real-time ESG scoring, cross-portfolio sentiment mapping. By the time your CFO sits down with a portfolio manager, that PM has already formed a view. The CFO's job is no longer to inform, it's to correct or reinforce a model that's already running. That requires a completely different level of preparedness.
Give me a concrete example of what that looks like when it goes wrong.
Look at what happened with a mid-cap industrial company. I won't name them, but they're in the European automation space. Earlier this year, their CFO delegated the Q1 earnings narrative to IR, who framed margin compression as a supply chain issue. Analysts had already modeled it as a pricing power problem. Those are two very different stories with very different multiples attached. The stock re-rated down 11% in 2 sessions. The CFO had the right data, but wasn't in the room shaping the interpretation.
What does owning the narrative actually mean operationally for a CFO who's already stretched thin?
It means 3 things get pulled back in-house. First, the strategic messaging for every earnings cycle. Not the script, but the thesis. Second, direct relationships with your top 15 shareholders, not just during roadshows. Third, the CFO personally reviews how analysts are modeling the company before every significant market interaction. Morgan Stanley published research earlier this year showing that companies where CFOs have direct analyst engagement at least quarterly trade at a measurable premium to peers, roughly 40 basis points tighter on credit spreads for investment-grade issuers.
Does that scale? Most CFOs I speak to say their calendar is already impossible.
It scales if you stop treating IR as a communications function and start treating it as a capital efficiency function. Microsoft's CFO, Amy Hood, reframed it internally years ago. IR sits inside the finance strategy team, not corporate communications. That organizational decision changes everything about how resources get allocated and who owns what.
One thing a CFO listening to this should do differently starting this week?
Read your last 3 earnings call transcripts the way a skeptical analyst would, not the way your team presented them to you. If you can spot the ambiguity before the market does, you still have time to fix it.
To go further, Leaders Insights offers strategic training programs, diagnostic tools, and an executive self-assessment designed for CMOs, CDOs, CFOs, and leaders aiming for board-level performance. Explore everything at mba-training.com. Thank you for listening to the Leaders Insights podcast. See you tomorrow for another episode.